What if I told you there are repeatable ways for the enterprising investor to beat the market? Not by guessing which stock goes viral next, but by using simple filters and a disciplined checklist. And what if I also told you some of the market's cleverest toys, convertibles and warrants, are often traps, dressed up to look like free upside? In this video we'll go through Benjamin Graham's playbook for the enterprising investor, how to find bargain stocks with real margin of safety, and how to think sensibly about convertibles and warrants so you don't get burned by financial gimmicks. Chapters 15 and 16 are addressed to the enterprising investor, the person willing to put in time and effort to earn returns above passive benchmarks. Chapter 15 gives practical selection methods, mechanical screens, conservative cutoffs, and real-world examples of how to build a portfolio of undervalued stocks. Chapter 16 then warns about convertible issues and warrants, how they're structured, why they sometimes look attractive, and the hidden risks they can introduce. Together they're a compact guide, how to search for bargains, and how to avoid clever traps. Graham starts by reminding us of a simple truth. Beating the market is hard. Even professional funds with huge research teams often fail to outperform the market net of fees. So if you're going to try, do it with rules that are sound, disciplined, and historically grounded, not with hunches or the latest hot tip. That's what Chapter 15 offers. Realistic mechanical ideas an enterprising investor can actually apply. Graham's core suggestion for the enterprising investor is to search broadly for undervalued segments the market ignores. Low multiplier stocks, net current asset bargains, and overlooked small or secondary companies. These opportunities aren't flashy. They're often boring businesses priced cheaply, which makes them perfect for disciplined investors. He shows that if you apply straightforward filters across many stocks, you can narrow to a manageable list of candidates worth deeper study. Graham proposes practical, mechanical screens that reduce the universe to workable candidates. Here are the core filters he walks through. Modernized wording. Low multiplier, cheap relative to earnings. Start with stocks selling at low PE multiples. Graham suggests starting with a pool of low multiplier names as your raw material. Financial condition. Current assets. Due 1.5x current liabilities, debt not excessive versus working capital. Avoid fragile balance sheets. Earnings stability. No earnings deficits in the last several years. Prefer records that show resilience. Dividend record. Some current dividend signals, management's discipline and cash generation. Price versus net tangible assets. Price below a conservative % of net tangible assets. Gives hard asset margin. Use these in combination. One filter alone is fragile, but together they create repeatable advantage. Graham's historical work found that buying a diversified basket of net current asset bargains or low multiplier issues produced solid returns over time. The catch: individual names can be risky or fail, so diversification is essential. Think dozens of positions rather than a concentrated bet. You're buying a strategy, not a single lottery ticket. Graham walks through creating a sample list. Start with the lowest PE stocks in a stock guide, then apply the extra filters: financial health, earnings, dividend, price versus net tangible assets. From a pool of hundreds, you'll often end up with a few dozen names that pass conservative muster. He gives a sample 15 stock list to show the approach in practice. It's a mechanical winnow, not a gut call. Graham also points to special situations: arbitrages, liquidations, mispriced closed-end funds, and corporate reorganizations. These can offer outsized returns, but require specific expertise, legal, accounting, and event timing knowledge, and often fast execution. For most enterprising investors, these are advanced tactics. Treat them as optional projects rather than core holdings. Graham recommends practicing on paper first, tracking your wins and losses, and ultimately limiting the total portion of your portfolio you commit to stock picking. Many successful practitioners keep the majority in low-cost index funds and allocate a small percentage to enterprising activity. That way, you get upside from skill without risking your entire plan on it. Convertibles are basically bonds or preferreds that can be swapped for common stock at a predetermined rate. Warrants are long-dated options issued by the company, giving the holder the right to buy shares at a set price. Both promise a combination: the protection of senior claims with the upside of equity. Sounds great, but the reality is nuanced and sometimes unfavorable. Promoters call convertibles the best of both worlds: income plus free upside. Graham warns that this sales pitch can be misleading. Convertibles often pay lower yields than comparable straight bonds, may be subordinated in the capital structure, and frequently show worse downside behavior than straight preferreds during market corrections. Warrants can feel like free upside, until you remember they're often issued in large quantities that dilute shareholders and can be wildly volatile. Graham shows that in many past cycles, convertibles and warrants issued near the end of bull markets performed poorly when the market corrected. The timing of issuance matters. Companies often sell convertibles when their stock is high, which makes the conversion feature less protective if stocks fall. As a group, convertible issues during euphoric periods have underperformed. That's a red flag for buyers swayed by the shiny pitch. If you still want to consider convertibles, and some can make sense, check these things first. Credit quality of the issuer. Is the convertible investment grade? If not, you're assuming equity-like risk. Conversion ratio and premium. How far above conversion parity is the bond trading? A large premium means long payback. Subordination and covenants. Is the convertible junior to other debt? Are there call features that can force early redemption? Impact on common shares. How many shares could be issued on conversion? Large potential dilution can materially change per-share economics. If any of these look weak, the convertible's safety cushion evaporates. Graham had little love for warrants. Their price histories can be extreme. They're often issued in huge blocks, and they can mask dilution by keeping the conversion price artificially attractive. He calls them bluntly, a financial fabrication, sometimes useful in tiny doses, dangerous in volume. If a company has a large outstanding warrant position, treat the common stock valuation skeptically until you quantify the dilution effect. If you aren't a specialist, a general rule is to avoid most convertibles and warrants unless they're issued by high credit firms with conservative conversion terms. You can quantify the conversion dilution, and it still leaves the common with reasonable value. You treat them as part of an event-driven, time-limited trade, not as a permanent core holding. Most enterprising investors are better served by straight bargains in common stock or by other special situations they understand well. Here are the concise rules from chapters 15-16 you can use right away. Screen mechanically, then study deeply. Start with low multiplier, financially healthy candidates, then dig into footnotes and earnings history before buying. Diversify bargain picks. Build a basket of many small bargains. Avoid concentration risk. Be highly skeptical of convertibles and warrants. They may look attractive, but often carry hidden yield, subordination, and dilution risks. Treat them as advanced instruments. Practice on paper, limit allocation. Test your strategy before using real money, and keep the enterprising sleeve a reasonable portion of your total portfolio. Which approach feels more interesting to you? Building a diversified basket of cheap stocks, or learning to spot special situation arbitrages? If you have one stock or one convertible Bosch warrant you've wondered about, drop the ticker in the comments and I'll pick one to analyze in a future video. Type analyze if you want a line-by-line case study. If this was useful, like and subscribe for more videos that turn old-school investing wisdom into practical steps you can follow today. Next video I'll take one of your suggested tickers and run Graham's enterprising checklist and a convertible warrant sanity check, line by line, so you can see exactly how the filters and dilution math work in practice. Say analyze in the comments to nominate a ticker. Thanks for watching. See you in the next video.